we are live.
And now we're live. Very good morning, everyone. Welcome to this webinar at which we will manage to cover pretty important speakers. I'm very honored to have online Everard Bourdieu and Andy Leon. My name is Anatoly Krachilov. I'm CEO and co-founder of Nickel Digital. But perhaps I'm going to pass to Everard and Andy to present themselves, to introduce themselves. And we have Andrew. Very good morning, Andrew.
Good morning, everybody, and thank you very much for attending the webinar, everybody.
Sure. We just started an introduction before we move into the questions. Everard, would you like to take over?
So thank you. Hello, everyone. My name is Everard Bourdieu. I am the CEO of Bourdieu Singapore. We are a merchant bank in Singapore, and I'm also a partner of Bourdieu in the group, and we are. Oops, you don't hear me? I think everybody.
I hear you very well.
As I said, I'm also a partner of Bourdieu Group, and the headquarters of the bank is in Switzerland. And we have offices. We have 3 banks and 2 asset management offices in the UK, France, Caribbean, Geneva, and Singapore. And we've just basically dedicated ourselves to private banking and private high net worth clients, and we've just entered the digital space.
Mm-hmm. Congratulations with that. This is advanced thinking. I'm glad to see you guys joining the space. Andy, over to you.
Hi, everyone. I'm Andy Lian. Right now, I'm in Singapore. I'm the advisory board member of Hyundai DAC. I am also giving advice to different governments in terms of their blockchain innovation, crypto assets, and I'm also behind some of the crypto bill that is right now in the space. Many people know me as an early adopter in terms of blockchain. Started a blockchain company known as an investor, and also wrote a book titled this Blockchain Revolution 2030. Good to see everyone.
Yes, thank you, Andy. My name is Anatoly Krachilov. I'm co-founder CEO of Nickel Digital. We are a London-based investment manager focused on digital assets exclusively. My past story, I've been in London for 20 years, for the last 7 years with JP Morgan and Goldman's. And 2 years ago, I left Big Finance to build an asset management specifically dedicated to crypto. We are running a range of investment solutions, starting from market mutual funds to directional exposure to crypto. And certainly kind of 2020 became this critical, pivotal year in digital finance, hence this conversation. Andrew, over to you to take over.
Thank you very much, Anatoly. Can I just confirm that everybody can hear me, because I did have a slight problem hearing some of the other questions just then. Can you hear me okay?
We hear you very well.
You can hear me fine. Okay. Excellent. Okay. Well, thanks again for joining. I think that what we'd like to start off, which I think we said originally, was the big question really is what is Bitcoin? What actually is this thing that we all hear about, we read about? We have a vague idea in some cases what it's about, but maybe we can have a brief explanation of what it actually is.
Mm-hmm. Everard?
You do it. Anatoly, you're an expert in that. So I think you are the best person to answer that question.
Well, the way we view digital assets here is really, if you look on 2020, it became a pivotal year for crypto assets, specifically because we had a massive response by the central banks to unfolding crisis triggered by COVID. And that essentially triggered mass kind of flooding market with money. And people such as Paul Tudor Jones back in May 2020 raised this important question: how do we protect wealth against potential currency debasement and inflationary pressure? because certainly kind of this flow of money will have an impact on the value of money, right? And the way we've seen this is really a hedge against inflation and currency debasement. And if you look on what happened in 2020, the amount of injection, or kind of put it this way, the amount of economic stimulus which government had to go through was enormous as compared to the previous crises. So McKinsey has released this report in mid-2020 showing that if in 2028, in 2008, Germany, for example, had put together economic stimulus package worth 3% of GDP. In 2020, it was 33% of GDP. And certainly that created this pressure on the monetary side. This slide, which you have on your screen, is perhaps the most telling to me, right? M2 money stock in the US went up 28% in a space of 12 months, which means roughly 20+% of every single dollar in circulation has been created over the last 12 months. And that's what triggered such a kind of significant demand for the hedge. And if you look on how significant is this 28%, right? If you look on the history, the only time when economic stimulus was of that dimension was in 1943. The US was going through the Second World War economic stimulus, and M2 at the time was 27% in 1943. The question, to what extent it triggered inflation in the economy? And the answer is, well, in the immediate proximity in 1944, it was still 2%. In 1945, it was still 2%. In 1946, inflation went through the roof to 18%. And indeed, it was post-war recovery of consumer demand which triggered this kind of, in addition to the liquidity already in the economy, caused this inflation. And from here, we are drawing parallel to the present times. And the question which is on the table, whether inflation may come and how can we protect that from that. And coming back to crypto, this is one of those, as I called, synthetic, non-discretionary asset. Synthetic because it was invented 12 years ago, non-discretionary because no government, no single entity, no single individual can adjust or inflate the number of units in the economy. The number of units, i.e. in this particular case, Bitcoin, is strictly limited. And from that perspective, we're looking at these assets as a store of value and in anti-inflationary hedge. I can go further on, but I would like to pass to Everard, to you and Andy before we go further.
Andy?
Andy, you there?
Andy, your microphone. We don't hear you, unfortunately. No, we do not. Everard, would you like to take over?
Yeah, whilst Bitcoin is one very well-known currency, obviously Ether is the second big one. So the other two ones is a bit different in the sense that it's also open source and blockchain based, and it's really used by others to create their own digital tokens. And obviously, it's a decentralized software platform used for its own cryptocurrency, Ether. And the great thing is also it enables small contracts and distributed application to be built and run without any downtime, any fraud, any control or interference from third parties. So these two are really today making 85% of the marketplace. And I think they really are the ones that people are interested into today. And I think these I think these are the ones which from a cryptocurrency are really interesting. And then more generally, is the blockchain and what is the future of this decentralized structure. And I do believe that to answer maybe the headline. Wealth managers should gradually embrace digital assets because it's here to stay. As Anatoly clearly mentioned, there's this flood of trillions of dollars that will weaken over time the price of most currencies, which will gradually depreciate. And people realize that taking at least a position, even a small one, into these new asset classes will give them a bit like gold and some kind of hedge against that. And so I think that in the future, more and more people will be used to have some kind of small portion of their wealth based in crypto assets. Andy?
Can you still hear me now then?
Yes.
Yes.
Sorry.
Yes.
So I think both presenters are very spotted on. The set cap made Bitcoin a more reliable than a lot of other scarce asset. It will eventually function as a store of value, in my opinion, and also as a means of payment. Even though that might not be the case today, but at this current point, I do see the value is growing. The inherent deflationary nature of Bitcoin leads to a lot of hoarding, speculation, and hence driving a certain price volatility. Can you hear me? Sorry, I got very bad feedback from my here. So anyway, but once once this Bitcoin has finished accumulating the value, when it becomes a large and liquid enough asset, it will be much stable than it is today. And this trend is already very obvious. So holding small amount of Bitcoin or digital asset would prove to be a lot more favorable than what we see today.
Mm-hmm. Actually, if I can add to that, I would look at Bitcoin specifically, and not necessarily as a cryptocurrency, although that's how it's generally known, but rather a crypto asset. The reason being that there's a very strong feedback. Sorry. So the reason,
if we all just mute in between speaking, that will help.
Mm-hmm. Yeah. So the reason being that when you name something a currency, there is a natural expectation this to be a very efficient mean of exchange. And actually, I can tell you, Bitcoin is not very efficient mean of exchange, right? Being able to process whatever 3 to 7 transactions per second cannot compete with even an old technology such as Visa International, which can process 56,000 transactions per second. But how do we have to view Bitcoin is really as an asset and some kind of reserve asset, which A, preserve value over time, and B, as Andy mentioned, has a deflationary nature rather than inflationary nature. And from that perspective, when you look from that angle, it really serves, has the attributes of gold. Because the reason gold is worth anything is really scarcity. Because if you were to find a new gold mine, and unintentionally, if you were to disclose to the world that we now have a mine with 5 times more gold than it used to be yesterday, we all know what's going to happen to the price. Price going to collapse for the simple reason we've lost scarcity overnight. Now, coming back to Bitcoin, it has this inbuilt scarcity on the protocol level, and that scarcity which actually defines its price. From that perspective, as an asset, it's better to be looked from that angle rather than currency per se. It may, over time, actually become mean of exchange as well, because with the layer 2 Lightning and other construct on top of Bitcoin, it may actually reach hundreds of thousands of transactions per second. But that's going to be in the future. For the time being, it serves one function: store of value, in my mind.
And Anatoly, you
can just sorry.
Everard?
No, I think Anatoly, you had a chart that was very interesting about the scarcity of Bitcoin and showing how much has been already issued. There you are, 89% of Bitcoin being issued, and only so little left. So the scarcity obviously will make it that there's value into it.
You're absolutely right. So the remaining 11% will be issued over the next 120 years, because the very last coin will come in circulation in year 2140 by design. And between now and all these 120 years ahead of us, we can predict with extreme precision how many Bitcoins there will be in circulation. Something we cannot do with the fiat currencies. For example, I can tell you exactly how many Bitcoins will be in May 2038. In relation, like, can you tell me how many dollars going to be in circulation in May 2048? The answer is no, because there is one entity which controls the supply, called Federal Reserve System. And there is no visibility how many dollars going to be issued. The only thing we can say with certainty, there are going to be much more dollars than there are today. With Bitcoin, you have this extreme predictability. And another slide shows how the system issues additional coins. Essentially, you have a certain number of coins. In the current times is 6.25, which are issued every 10 minutes. And then if you see this is like 6 cycle on 1 hour, you extrapolate over 24 hours and 1 year, and the total number of coins which are issued over a year in current times is roughly 1.7% of the coins in circulation. So this is your current inflation, which is inbuilt, 1.7%. But what we know that every 4 years, the number of coins issued by the system halves, i.e. drops 50%. And at the outset in 2009, the number of coins were 50 Bitcoins per block. Then it dropped to 25 4 years later. Then it dropped into 12 and a half. And currently, as we're going through year 2021, it's 6.25. And we know in 2024, it's going to drop to 3. And that's what creates this logarithmic scale of Bitcoin issuance, right? It goes into kind of flat line, horizontal, and then at some point ends. And that's what creates this very unique, very transparent, and a very predictable monetary policy.
Now, thank you, Anton. That's very excellent explanation, and some graphs are very, very useful. I'd like to. I know Everard has to unfortunately leave us at 12:30. So I want to move on to really one of the questions, which is talking about the wealth management sector. Now, Bourdieu have recently linked up partnership with Sydenham on your project around cryptocurrency. So why do you think, Everard, that the wealth management client should consider digital assets as part of their portfolio? And the second question on this is, what challenges exist for private banks and wealth managers in handling this business, such around custody, settlement, and regulatory concerns?
Awesome, thank you, Andy. So yeah, we decided to enter that space exactly for the reason that was Anthony mentioned, is to say, look, there is an incredible amount of currency being issued around the world, and over time, and we need to find alternatives. People think about what they can do, and they look at the stock market and how good it's been going the last year, and you're thinking, oh my God, will it continue? So talking to many people, we decided, okay, it's been about 18 months in the making, decided to say, okay, how can we give access to people in a simple manner to digital currency? Because the problem that many people face is they have to open an account with Coinbase or with someone. It's complicated. There's all these, they have to keep their private keys. And we saw, how can we make it simple for people to access this, and more importantly for the wealth management space, how do you allow relationship managers to get used to trading in digital currencies? And so we decided to partner up because with in that case Sydenham, but I think first because we believe in partnerships. We believe that we cannot be the best at every areas, and especially in today's environment where things become more and more specialized. And we think that specializing with associating and partnering with trust companies, with lawyers and with the people in the crypto space make a lot of sense, because it's really a world in its own. And it would allow us to learn and to obviously build or create or get a bigger, stronger partnership over time, and decide what to do going forward. So we took Signum because they are obviously an institution that has both offices in Singapore, and they are FINMA licensed in Switzerland as a bank, a digital bank. So there are only 2 digital banks, and that gives comfort from the risk level, because the first thing obviously that people think is who takes the liability. So in our case, we said, make it simple. The client will be very much aware that he takes the liability. It's execution-only clients that will do it, and he takes full liability when custodizing his assets with Signum. And we started by saying, okay, what could we do? And we said, let's start because as you know, the Bitcoin goes 16 digits before the comma. So it means that our IT system couldn't handle that, because any security doesn't have 16; they have 5 number. So we had to adjust our system to allow the ability to just put even the number of crypto that the person holds. So we said, okay, let's start with Bitcoin and Ether, because these two, ETH and Bitcoin Cash, these 3 asset class are the biggest ones, and also we have to get used to it. We have to use from our system, and we have to get used for as I said, for the relationship managers, and we have to get used from the client perspective to tell them, look, how much should I hold in digital assets? I tend to say like 5% should be something that should be considered, but already 5% may be quite large. So we first started. We made the agreement with them about, I would say, 9 months ago. Then we started testing to see if it worked, integrating our system, and so we came live, I would say, at the end of the year in Switzerland, and now we're working in Singapore, because the problem of this crypto is obviously you can trade them anytime, and it's difficult to say to someone who wants to trade Singapore times, oh, let's wait for Europe to be open to pass your orders. It's still, you have to be able to adjust and the funding to be done. So we're still getting that through the little hoops here. Obviously, MAS is informed, and so we're trying to do things very much properly. So it's a bit more complex than it looks, but the aim is obviously to get people used to this, and then when they are get used to those basic 3 cryptos, is then maybe going to go funds, then we can do some derivatives on it, then people can start to enter and do much more. But at this stage is really our first step into that world, and making it simple, as I said, and making it easy for people to view their portfolio globally, both their securities and obviously their usual securities and their cryptos together in one statement. And over time, we'll see where it goes. But I think it's very, very exciting, and we need to. I think it's very important that we get into that now. And now, obviously, the price of crypto, like the Bitcoin, is ridiculously. It's very volatile. So it's very interesting to see where it's going. So it came at the right time, but that we didn't know. I think we have to stomach the volatility that's becoming a standard. And there you are. That is, I think, a little bit of an explanation.
Well, we've actually had a very good question. Thank you, Everard. We've actually had a very good question which has just come in, which is from one of our guests listening in. Is your expectation that custodial function of coins' private keys will be done by the wealth managers directly, or outsourced to an external party?
It's a very, very good question. I don't know how the custody function will take place. We obviously rely now on an external party to do it, and because they are locally licensed. Obviously, we need to have more time for the market to develop to determine where it is. I think probably external party. That would be my take. What do you think, Hassan?
Well, I have a very strong view to that end, that it has to be a third party. And the reason for that is as we know, the whole blockchain structure is based on the immutable, not immutable, it's immutable, B, it's one-way street. If the asset is gone for whatever reason, you can never recover it. From that perspective, we have to put security around how do we hold private key. And we believe if one person or one organization holds private key, that creates a single point of failure. If something goes wrong on the company level or even on the personal level, right, kind of employee who holds this key, at stake is way too much, right? Kind of we're going to millions of dollars which can disappear in an unrecoverable manner. From that perspective, you have to split the key between few organizations. And then you have to organizational exactly when you have few parties involved, a private custodian, an independent custodian, an independent fund administrator, and you as an investment manager or wealth manager. And then the key normally would be split in 3 parts, and then it has to be combined in order to sign a transaction. And that what creates a very resilient structure. So there must be a third-party custodian for the security reasons. Andy, would like to have a go on that?
Sure. Can you hear me? Hi.
Yes.
Sorry. I think it should be a third party as well. There will be a multi-signature kind of model, so to secure your client's digital asset. But on another note, we always tend to say that, if you don't have your private keys, all your Bitcoins are not yours. So on another interface or dashboard, you could also look at the possibility of letting your client see all the on-chain activities and some other on-chain transaction to let them feel safe about some of the investment that they have made. There are a lot of other ways to do this since we have moved on into a more blockchain era. And again, since we are on 24/7 as well, on-chain custodian and on-chain dashboard and several other functions should be present in the private management space to give the customer more power and more empowerment to their investments.
Yeah. To that end, I would say control your key is a mantra generally accepted in crypto space. It's good on the personal level, perhaps on the level of possibly family office. But once you go into fiduciary asset management, of course, you have to split this control over key over the several parties. And that slide actually depicts exactly my earlier point. You take a private key, which is the 64-digit long alphanumerical code, you split it into 3 parts, and then cryptographically distribute between 3 parties. That's the way to manage third-party capital. Yep.
Well, we have another question just come in as well, which is, what are the short to medium term challenges facing professional advisors as governments seek to increase regulation?
So just before I leave, that will be my last interaction, is to answer that question, is that we have incredible legislation being drafted surrounding the crypto. In particular, I think CRS will come in for crypto. And I think they're going to do a CRS that is completely different than the CRS that is currently done. FATCA also, I think, reported for the US will change. There's tax angles. Not only will the crypto will be taxed, but also at a different rate, different regime for different countries. So as the asset class becomes norm, more and more regulations will come in to try to tighten things in. And I think that's where it's important that being regulated and playing by the book is the future, to my opinion. At the beginning, everybody could start to do a lot of ICOs and deal with crypto, but now it's going to come down to being much more regulated. And I believe really that that is very, very important that people are aware of it. Although it brings a lot of opportunities as well, because obviously once there's more regulation, institutional investors come in, people get more comfortable, and there's really a development of that. So I think it's both a curse an amazing opportunity to have that. But regulations will come thick and fast, both in the EU, the US, and regulators as well will start to ask for more. So I think that's my take. I will leave it to Anatoly now, and I would like to thank everyone for having joined this panel, and I apologize that I have to leave now. Thank you very much.
Thank you very much, everyone. I do appreciate you taking your time. Thanks indeed.
Thanks.
Yeah.
Okay.
Right.
So, I think if we.
Yeah, I would like to pick
Sorry,
on
Anatoly, please go on.
Yeah, on regulation. Actually, from our perspective as a regulated asset manager, for us, regulation coming to this space is actually something we embrace. Because as Everard correctly mentioned, that will allow institutional capital and professional capital to come into the space, because there's going to be more clarity as to how can you operate in this space. And as to how government around the world view crypto, I believe there is a trend which is generally can be summarized as let's embrace, regulate, and tax it rather than fight it, right? And if you look at the US, there were two major events last year and early this year, both by OCC, Office of Currency Controller. So first, in September last year, they formally allowed commercial banks in the US to custody digital assets. So essentially, a regulator comes and allow 8,000 banks to get involved in crypto. And that gives you a first preview. They're not really kind of trying to ban it. You don't jump out of the bushes 2 months later with the screaming, now we're going to ban it. Like, why would you create distress to your own banking system? Of course, that was already kind of a direction of travel. Let's integrate. But the biggest thing came, I think, in January this year, on the January 4th, the same OCC now allowed commercial banks not only to engage on blockchain in parallel with SWIFT and FedWire. Essentially, we're saying that stable coins such as USDC and others can be used in parallel with the traditional banking system. And that's a major breakthrough, right? Kind of, and in addition to that, what commercial banks were allowed now to become part of distributed systems whereby they are one of the nodes. And you would remember that Bitcoin, Ethereum, they all run on independent nodes, i.e. individual servers, which are contributing computing power to the entire network and assuring its security. Now, the message to the commercial banks in the US, you can engage in this activity. And to me, this is a clear path to general integration of old financial system or traditional one with crypto. Basically embrace and regulate rather than ban. And over to you.
Hi. I think.
Guys, you're on the mute.
You can still hear me?
Yeah.
All right. So I think the rules in different territories are very different, and like what Andrew has mentioned as well, things are starting to be more embracing. The very fundamental reason why I joined the government and giving advice to government is because I do believe at this very early stage where we are at right now, regulations are actually very important. If you again look at things in 2017, where regulations are much muddy and not unclear, we tend to be a fair bit more innovative, taking on a more daring approach. But when we are talking about the current situation in 2021, where regulations are more in place right now, we do see that funds, we do see more institutions coming into the space to put up sizable investments in billions of dollars, millions of dollars, and so forth. But if you look at things in general, in different territory, the financial service commissions or the FSCs are mainly taking control. As long as we look at things like how we look at the traditional banking, like AML, CBT, KYC. I think all these are very familiar terms that we are dealing with in the traditional banking world. As long as we follow the same principle, we are safe in general. And again, it depends on where we are operating at. Whether you are, maybe example, in Singapore, in Korea, you are generally fine. If you're in China or in India, things can be a bit more illegal and sticky. So we just need to follow the regulations and work in the best interest of your client. If you look at the wealth sector. So for the client side of things, I think the regular tax applies. So if you are looking at Singapore and Australia, we have to look at things like goods and services tax, because in Australia, Bitcoin is being seen as a property, and also the normal personal tax gains and so forth should be accounted for, just the same as how you get your profits from your other source of asset. So buying crypto is not an easy thing, and again, for many, even for our own fellow friends, in the crypto space, it's not easy. So with the added layer of service and analysis from the private and wealth manager, it is actually a lot easier for many high net worth individual, and it's also very easy for them to create that additional layer, to help them to go around with things like custody, settlement. How are they going to go about converting their fiat into a Bitcoin or something? So I think that added layer has given the whole industry, both the traditional and the crypto industry, an added edge as compared to things back in 2017. So it's actually a very good thing right now.
Mm-hmm. Yeah.
We have a couple of questions as well, which I before we sort of move on to our final question here. But one of them is someone said that I'm a quant researcher and trader, and unfortunately I see crypto trading as a more risk security compared to traditional regulated capital markets. Asking our panel, what's the take on that?
Maybe I will answer this because I used to also invest in a quant this platform as well. I think it depends on whether you are taking on this question as a researcher or as a trader. Because if you are a trader, the kind of a high risk, high return, and you felt that you could make very good decision from the trading, makes you think that you have a very good upside. So it really depends on how you see it. So if you say that cryptocurrency is very risky, but if you look at it from another standpoint, for some coins, I'm not going to mention who and so forth, it might have dropped 27%, 28%, even 30% in a day, but the next day it got bounced back, right? So I think, of course, it's volatile, but there is a chance of rebound. But if you look at the stock market and maybe other forms of security, once it goes down, it most likely, it's most likely down. It's not everyone is a GameStop, where the stock can goes up. So that's my take, though.
Yeah,
I think that's an interesting point. I mean, if you look at the way that Bitcoin has gone from 3,500 in March last year to 58,000, then back down to 43, and it's up another 7% today at 54,000. That really does show the volatility of it, and why it's definitely on the risk side of an investment asset. That's for sure.
But on the other side, you can also see that because of the upsides that you can see right now, a lot of other funds and also digital asset management guys are all coming into the space, because they do see that there is a very good uptick and also a very good market that they can get themselves into. I'm sorry.
Yeah, so I'd like to add to that certainly this asset class will remain volatile for the foreseeable future. And there are a few reasons for that. One of them is structural. And coming back to our monetary supply, which we discussed around Bitcoin, because you have a very limited number of coins issued per block, which is 6.25 coins. Whatever is the demand can triple tomorrow. The number of coins issued by the system will remain at 6.25. Demand can go 10x tomorrow. System will still release exactly 6.25 Bitcoins, which means you have a perfect inelasticity of supply. Supply is not reacting to the increased demand. And that means that the only balancing factor between growing demand and limited supply happen to be price. Price will remain very sensitive to the inflow of capital. And as to the inflow, coming back to our earlier slides, you may see that you have MicroStrategy coming back in August with $424 million. Then they topped by another 600 million in December, then by another billion in January. Essentially, this is the inflow from large corporate players. And of course, they are vacuum cleaning all available coins in the market. What happens with the price? Price experience upward volatility. Same happens with PayPal. PayPal allowed back in October its clients now to acquire Bitcoin using the platform. And that causes now kind of easy access for retail clients into the market. So PayPal has to come out into the market and buy on behalf of their clients certain volumes of Bitcoin. Well, in recent times, PayPal has been buying 70% of the entire supply of new coins. Square, another payment company, buys another 40%. So these two entities are buying 110% of all newly minted coins. And of course, what we're going to see, a price drifting up as more and more players coming to the market. Another thing which adds to volatility is size of the pool. Bitcoin is still a very small asset, right? We just recently crossed 1 trillion market cap. In the context of other assets, gold, for example, is 10 trillion, equities, 80 trillion, fixed income, over $150 trillion. Back to Bitcoin, just 1 trillion. Of course, because of this size, any inflow will impact price in a very significant manner. However, as the pool grows, so will volatility get reduced over time. Because if you take a cannonball and drop it in a swimming pool, the ripple is going to be very significant. Drop the same cannonball into the ocean, the guy on the other side of the ocean will never feel it because the size of the pool matters. And that's how this space will evolve. In terms of trading, of course, it is a volatile space. For people who can trade volatility, that's a beautiful asset class to be involved. And in context of Nickel Digital, our firm, the very first fund we launched 2 years ago is exactly volatility trading fund, market neutral arbitrage. So for us, movements in this market represents an opportunity. But what we managed to do, for example, is take this extremely volatile market, and vol in Bitcoin volatility, implied volatility is 70 to 100%. And we managed to convert that into the stream to our investors at the level of 2%. So 70% converted into 2. So basically, using financial instruments, you can reduce volatility. But in order to capture the upside, of course, investors should get exposure to this asset class, direct exposure, and hold this asset. But again, what we would like to kind of give as a message, that people should look at this asset class not necessarily as a speculative asset. That's how it came to be, right? And that's why many people involved in that. But I would say there is a value of holding this asset without speculative agenda, but purely from the portfolio construction point of view. And here I'm going to show you one slide, which I found extremely revealing. The logic being, if you look on the, forget about Bitcoin for the time being, right? And let's look on the portfolio, which is 60-40. 60% equity, 40% bonds. And this is traditional portfolio, which is used in wealth management. Without any crypto involvement over the last 8 years, and that has been analysis was recently completed from December 2012 until December 2020, such a portfolio have delivered 124% cumulative return, which is great. It was kind of a bull run for the last 8 years. Annualized risk of this portfolio, standard deviation, was 10%, and max drawdown is 21.6%, largely caused by S&P falling in March last year in 2020. Now, if we go into some intellectual exercise and ask ourselves, okay, what impact would have Bitcoin added to such a portfolio? Again, it's not speculation, it's just kind of diversification exercise. So if you were to add 1% of Bitcoin, having clawback 1% from equities, the impact is as follows. Top line goes from 124 to 146%. It's a solid 22% add-on, just for the sake of 1% added Bitcoin. But what counts as completely counterintuitive is that standard deviation, the risk of the portfolio, actually goes down. So from 10%, it goes to 9.95. And your max drawdown actually improves as well. And the question, how on earth you are adding a very volatile asset class and yet your risk framework improves? And the answer is uncorrelated nature of this asset. And on this slide, what we've done, we have collected all drawdown at S&P 500 for the last 10 years. And then superimposed on top of that, what Bitcoin did over these periods of S&P drawdown. And in here, orange bars represent how S&P performed, and blue bars what Bitcoin did over the same period of time. So in April 2011, Bitcoin was down, S&P was down 19%, the famous tantrum, right? What Bitcoin did at the same period of time? Well, BTC did not realize there was a market sell-off and went up 76%. And you can see the number of observations. It's very often Bitcoin behaves very independently. Certainly, there are times when both Bitcoin and S&P go into sell-off. But generally, there is this independent behavioral pattern. And that's exactly, as an investment manager, what you would like to own, because that gives you diversification to your overall portfolio and improves your efficient frontier. It shifts the efficient frontier up. And coming back to the 1% slide. So if you go into more kind of adventurous mode and add 3% Bitcoin to your portfolio, so the effect would have been from 124, return on the portfolio goes to 196. This is a solid 72% increase in performance just for the sake of adding 3% Bitcoin. And risk stays at 10%, goes to 10.05. I'm happy to take extra 5 bips of risk for the sake of adding 70% to the top line. And that's what creates this unique impact on the portfolio. Again, we're talking about construction of the portfolio rather than speculation. Andrew, over to you.
Yes, I would. I was just going to come on a couple of questions which have been very, very interesting, actually, which I'd like to run through. We have one which is asking if large whales control a lot of Bitcoin, surely they can manipulate the price downwards at any time. Andy, what's your views on that?
That's definitely the case, right? I mean, we love how Bitcoin is and how we talk about the supply and the demand, and of course, you know, we have to also understand that there are other properties of Bitcoin that is very similar to the traditional market, right? So if there are big whales coming in, are they able to control the price? My answer to you is yes, they can. If they are going to dump their Bitcoin at a certain time, you know, depending on the acceptance of from the market, yes, it will drive the price down. Similarly, the other upside is if you get a lot more corporate buyers coming in, treasuries started to build on their Bitcoin portfolio as well. You will see the price increase. So so sometimes we always caution some of my own friends as well, who are in the traditional space. You just got to put X amount of dollars that you are comfortable with into the crypto space, because the space being very volatile may not be what you really want, because your investment appetite is very different from a client to client and so forth, or from people to people. So you just got to put in the right amount of money, into the crypto space. So yes, we do see that there are ways to manipulate the price, because as we rightfully mentioned, price become a very sensitive thing. When we see all the different news, good news coming in and so forth. So same for dumping as well. So I hope that answers your question.
Thank you, Andy. It does, and I think we also have something which I wasn't aware of, and I don't know if you guys were aware of. Which we have a good question, which is us saying that the first Bitcoin auction in France will take place on the 17th of March. And do we think that this will? Do you think this will allow, as for the art market, that the Bitcoin could be priced officially by the fact that it's been auctioned? And Anatoly, what's your view on that?
I'm not sure whether they're going to be. Is it art auction?
I think it's an art auction. It's not a Bitcoin auction.
Yeah, okay, because Bitcoin auction would be kind of a very unusual thing to say when there's a perfect marketplace. No, for art, I wouldn't be surprised if that becomes perfectly legit way of payment for art. Look, Elon Musk has briefly announced at some stage Tesla would be happy to accept Bitcoin as a mean of exchange, a kind of mean of payment. Nothing wrong with art being priced in Bitcoin as well for the transaction purposes. So I would expect this to be widely accepted 3 years from now. And this French auction is perhaps a preview what is coming in this market.
No, I think actually the questionnaire is saying that actually it's an actual Bitcoin auction. So it's not an art auction where you can pay by Bitcoin. It's actually someone is actually auctioning Bitcoins. I don't know how many, and maybe it's something we can look at independently. But it does ask whether that if it's been auctioned, there, will that price then be determined in the market?
Well, the price today is the market can absorb a significant number of coins. The volume which is going through the market today is measured in billions of dollars. If you're gonna put certain number of coins for the auction, market will absorb this, right? There might be some discount, which is really, if I as a trader take this temporarily in my position, in my my stock, right, my inventory, I will need to compensate for that risk. But generally, nothing prevents from large volume to be just kind of distributed across the market. And people like us who are arbitrageurs, we would make sure that this is done in an efficient manner, rather than with some price gaps of 5% or so. That certainly kind of is not happening anymore, because market becomes more and more efficient. There was another.
Now, I put a question out onto the audience, and which was one of the final questions.
Mm-hmm.
Oh, sorry, Anatoly, please go.
Yeah, so another question: whether the SEC would approve a Bitcoin ETF in 2021. I believe we're very close to that. First, you had similar approvals in the north neighbor in Canada. Essentially, 2 ETFs, Bitcoin ETFs, went live earlier this year. And I don't see how US can hold for longer without allowing this market to go ahead. And if you look on Grayscale, which up until recently and still is perhaps the largest pool of Bitcoin in one listed vehicle, it's not an ETF, it's a trust, which is far less efficient than any ETF. And you would remember there was a premium on the secondary market as high as 35%. And essentially, if you are a retail investor coming into Bitcoin market, buying Grayscale on the secondary market for the luxury of owning Bitcoin, you would be overpaying 35%. And of course, it was very unsustainable. And our view always has been that this premium will disappear immediately as ETF comes to the market. And then as an investor, you have a clear alternative to go and buy an ETF. Why on earth would you buy a trust shares, right? Overpaying 35%. And surely enough, with this premium, it went down to zero couple of weeks ago and then went into discount. The most recent was like 11%. The reason for that is because ETF is coming and market is anticipating this development. And for that reason, the premium went down to zero. So only a matter of time.
We also have a question. We also have a question saying that do we believe the MSCI will introduce a crypto asset index? And if so, when do you foresee this?
I think that's going to take slightly longer than an ETF on a single asset, being Bitcoin. If MSCI goes for index, which may be whatever, top X number of coins, that will take slightly longer. I wouldn't expect this to happen in 2021. But as this space matures and demand is certainly there, it will come as a tradable instrument at some stage.
So I think we're coming up to an hour now, which is a little bit longer than we had anticipated. So it should be great because I think the questions have been fantastic, and I'd like to thank the audience for their participation in this. The final thing which I did put up on the question here is, and I think we probably know the answer to this, is that, are we at the top of the hill with the crypto market, or are we at the bottom of a very big mountain? Andy?
Well, the purely personal take, yeah. I think that we are at the bottom of a mountain. It will continue to rise if there are demand. Right now, you can see that the demand is very strong. The current situation is backed by institutions, corporations, treasuries, family office in this recent price rise, and most of them came in at around $47,000, right? This is very different from what we see in the 2017 situation, where most of the Bitcoin are backed by retail investors. So I do see that we are at the bottom of a mountain. But on a more cautious side, if you look at how the price is continue to be pumped at this current amazing speed, that we are seeing right now, I do felt that there might be some areas or some sentiments that it is not sustainable, because the price increase, in my opinion, should be a lot more gradual and not a very steep upward rocket kind of a situation. So we have to be very patient about it, right? And if you again look at the space around us, I'm speaking from Asia, in Singapore. I think the demand in Asia is extremely strong. We do see listed companies in Asia buying cryptocurrency quietly. Of course, in the news, Meitu, a Chinese-based app company, bought 40 million worth of BTC and ETH. I mean, this is just one of the many companies that I know who formally announced this to the public. In the last 2 weeks, I've spoken to about 8 funds and a few other corporations as well, fairly large ones, introduced to me by different governments and different stakeholders. They are all going in for Bitcoin. So if you were to ask me, is it going to be a very optimistic kind of situation in the very near future? I do see that happening because a lot of buy-in are happening. And lastly, I also want to add on to the point. We are not just talking about Bitcoin right now, right? There are a lot of other altcoins that are in the market, probably 5,000 of them in the market. The top few ones are also very promising. You can see very potential good upsides and so forth. So it will eventually shift to a more altcoin market in time to come, because if you talk to different funds or different people with the money, they are thinking of creating their own Ethereum. They are thinking of creating their own Polkadot as well, because they have the money. Why play with just Bitcoin, right? So my very last word would be utility of the coin is key. The blockchain technology behind is actually the fundamental value behind it. That creates the fungibility of Bitcoin as well. Not so much just about the supply. And another word that I would like to echo is that Bitcoin or the crypto industry is still very early. If you have not gotten in, you should really think about how you can get in, or how you should try to know more. All right, and the value really lies behind the technology, and that will be something that we realize in the very near future. So, thanks.
Yeah, I would add to that
Thank you very much, Andy. And
yeah, if I can add, Andrew. So I would certainly differentiate between Bitcoin and the rest of crypto market, because to me, Bitcoin has solidified its position as a store of value, right? And many corporates who are coming today into this market, first of all, they're accessing Bitcoin market rather than altcoin markets, right? Now, the driving force behind that, as we discussed, is hedge against inflation and monetary debasement. This trend is just started. We are seeing, we're specifically refraining on the nickel level to name any price target. However, there is no shortage of price indications by very respected organizations. You have JP Morgan with 146,000. You have Citibank with 318,000. You have Guggenheim Partners with 400,000. And recently, their CIO mentioned 600,000. And whilst I would stay away from kind of giving any number, I think the trend is clearly identified, because you have this inflow of capital coming into this market. And as we discussed, there is certainly limited supply, and that will create upward pressure. Now, where we are in this cycle, it's important to realize that market moves in cyclicalities. And one of the things which usually people look at this market is in a linear fashion, linear graph. And linear graph does not do justice to this, to the analysis, because usually you would have a very large spike in 2017. Anything before that is pretty much straight horizontal line. It's just getting lost in the one-off major spike. However, if you look on the price of Bitcoin in a different context, in the logarithmic scale, you can immediately see these patterns evolving in Bitcoin price. And that happened to be 4-year cycle. Why it's 4-year? Well, it happened to coincide with 4-year halving cycle. Every time when supply goes minus 50%, as it did most recently in 2020, that creates squeeze on the supply side. And demand is there, continue to build, and that's what creates this price action. So if history were to be of any guide, I think 2021 is going to be a very powerful year of Bitcoin price appreciation, for the simple reason it happened to be the 4th year in the 4-year cycle. And 2017 in previous cycle was exactly the 4th year. What we saw then, well, year in 2017 started with a roughly $1,000 per coin. And whilst there was a screaming around the press, like, hey, the price reached previous heights, it's time to sell. Well, in retrospect, actually, it was perhaps a time to buy, because in 2017, market has expanded 17 times from roughly 1,100 all the way to nearly 20K. What happened then? Market just overrun itself. It just got thin, too stretched, and that caused a significant price fall. And then we entered crypto winter, which lasted for a year, and that was minus 85% price correction. But then it took 2 years for Bitcoin to recover to the previous height. And surely enough, by December 2020, we were at the previous 20K. And again, if you were to ask yourself, what is happening next? Well, it's a 4th year of the 4th-year cycle. And that's how 2021, as we entered that, we continue this ride. So we're standing at 50 plus today. It's very likely to continue this way for foreseeable months within 2021. So this is a very powerful dynamics in place. And to me, it's driven by structural adoption of this asset class. There is speculation, no doubt about that. But as Andy correctly mentioned, Now we're having different type of capital entering the market. It's not purely retail speculative capital. It's now institutional capital. And look on the statements by MicroStrategy. These guys have exposure roughly, is it $3 or $4 billion now? And it's $4.5 billion, right? And actually, this is a very sticky form of money. They will not sell the position as soon as market corrects by 20%. As a matter of fact, they will be buying more. For them, it's a long-term capital allocation. And that's what makes this rally so much different to 2017, is by far more sustainable rally. And I think at some stage, we're going to reach kind of some local peak, because market again going to overrun itself. And no doubt, there's going to be another crypto winter. But it's likely to be less severe than the previous one, because we have different type of capital now entering this market. All right, thank you, Andrew.
Thank you, Anatoly. I mean, I think we are going to wrap this up now, but just to be some fascinating insights into the market, and without a doubt that the wealth management industry needs to embrace this, and that crypto assets or altcoins, whatever one it is, they are going to be part of people's portfolios going forward. As we are wrapping up, I put my email address up on the screen for our guests, who, if any further questions which they'd like me to put them in contact with Anatoly, with Andy, and with Everard, be very happy to speak to you offline and directly. But then again, thanks again for everybody who's attended today. I hope you have found this interesting. Thanks very much to Nickel Digital Asset for being our partner with this today, and to Andy and to Everard for taking part. Thanks very much indeed.
It was a pleasure. Thanks a lot.
Thanks a lot, everyone.
Cheers. Thank you.
Nickel is a firm that combines an understanding of digital assets with many years of traditional financial expertise with technology smarts.
Nickel, a group of investment professionals coming from traditional finance, namely JP Morgan, Goldman, Bankers Trust, Deutsche Bank. So combining this experience from the conventional finance and technical expertise, we're pulling these resources together to create a platform via which investors can access digital assets market.
So in order to build a successful manager in the digital asset space, you need three types of expertise. You need experience of trading traditional financial markets. You need experience of trading the nascent digital markets. And on top of that, you need the computer science experience in order to build procedures around your custody and movement of assets, and just to build a trading system that will effectively execute those trades at the exchanges. I think what's unique about us is that at the founding partner level, between the three of us, we cover all three of those. We have 6 years of experience in traditional financial markets. We have 20 years of experience building our trading software. And now we have over 10 years of experience of trading crypto specifically.
The market is ready for custody solutions that have been developed by Nickel. Before, crypto custody was insecure and unreliable. Now, with the solutions that our partners have developed, it's secure, insured, trustworthy. In short, it's ready for institutions.
The market has evolved over the last few years to offer a secure way to access the market. If you think a few years back, people would use what is called self-custody to custody digital assets. We believe that was not really an institutional way to access the market. Today, we have these solutions in place.
The initial investment solution we brought to the market is the Digital Assets Arbitrage Fund. It trades strategies like futures basis, calendar spreads, volatility arbitrage, a whole number of market-neutral, sophisticated strategies. The reason why we began with that was to prove to the market that we can build an effective execution platform where we can easily manage the risks of these sophisticated market-neutral strategies.
We chose to do this first because it's the hardest thing to do. All the other products we can launch after this will be simpler for us to implement. The second product is the Digital Gold Fund. That is a long-only Bitcoin solution that's secure, efficient, and liquid.
Digital gold is a natural extension of the expertise we've gained trading the arbitrage fund. We can execute trades much faster and much cheaper than anybody else in the market, putting us in a very advantageous position to provide this long-only product.
Digital assets are a a huge opportunity to transform finance, giving investors access, control and liquidity in a cost-efficient way.
Digital assets is a standalone asset class, like venture capital, private equity. And from that perspective, over time, it will make way into portfolio allocation of pretty much every institutional investor.
I think our goal here at Nickel is to build a one-stop institutional shop for all of your crypto investment needs. We think that the market, as it develops, will provide a lot of democratization of access to different types of instruments out there, be it real estate, be it private equity. We think we will provide the technical solution to trade all of those markets.
So we believe digital assets offer new and exciting chapter of finance, essentially offering greater liquidity, greater transparency, and greater efficiency of financial flows.